3 years ago, I opened a Roth IRA, opened a 401k through my company, and I started opening my own individual tax brokerage account. And now I'm on track to hit millionaire status in just under 30 years, stress-free. In this video, I'll walk you through the exact steps that I took so you can replicate this and become a millionaire in just the same amount of time as me. I'll walk you through exactly what I did, the rules I followed, and the funds that I've been purchasing and investing in. Before we invest, we gotta make sure of two very important things. This is before we even open our accounts and we start throwing money into these type of investment accounts, right? First, it's to make sure that we have an emergency fund of 3 to 6 months of expenses. And two, is to eliminate any debt, specifically high interest debt, right? We can have low interest debt if it's calculated and we have a plan for it, but high interest debt is the specialized we need to get rid of, right? If you don't have 3 to 6 months of expenses saved up into an account, primarily you want to use a high yield savings account that you can get at least 4% from. You should not be investing in retirement accounts because you won't have that stress-free mind. Because if anything happens, right, if you have an emergency and you go to the hospital and you have to stop working for 3 to 6 months, you need to make sure that you're going to be okay in those times of needs. And you don't want to pull your money out of these investment accounts, because then you're just setting back your progress. So make sure that you have 3 to 6 months of expenses in a high yield savings account, or you're really not ready to invest. Investing is really supposed to give you peace of mind for the long term. And for the debt, right? If you're paying 23% interest on your credit card, you really should not be worried about trying to get 10% annual returns on the stock market. You need to be focused on killing that credit card debt immediately. You need to focus on killing all high interest debt immediately, and then we can focus on the long-term success. Because those short-term debts, right? They will add up and they will stack up unless you get rid of them early on. Even low interest debt like student loans, you really want to think about it before you start investing. But just make note of that, because low interest debt, it can still pile up depending on the amount. So those are more flexible, but still think about it. And initially when I first started, I was just picking like the big name companies such as like Apple and Nvidia, but I never stuck with the thing. I never stuck with a single stock or purchase I made. I would just do this, buy it. Oh, it'd go up, it'd go down, up, it'd go down. Okay, I'd sell it, whether I gained a couple percent or lost a couple percent. And I do the same with Apple, Nvidia, even Dogecoin, right? I don't want you to make that same mistake. You don't want to be buying individual stocks for long-term success, right? You want to start buying low-cost index funds and ETFs to where it's diversified already. There's a lot lower risk involved with these decisions. When I was doing that, it was really scaring me and I was really unsure of the choices I was making, right? It felt like, honestly, I was gambling, playing blackjack, and you don't want investing to feel like that, right? So we want it to feel like a well-built plan for our success. We want it to feel like a well-structured plan for our success and wealth down the line. I'm really gonna go over the principles that I use to invest in my accounts. So the first principle that I follow when making my investment choices is to make sure they're already pre-diversified stocks and ETFs or funds. Essentially, I'm choosing things to invest in that are already diversified into, let's say, hundreds of companies. For example, like the S&P 500, such as the FXAIX, Fidelity's tracker of the S&P 500, or VOO, the Vanguard's tracker of the S&P 500, right? There's little small differences and nuances between each company, but the main point is that those stocks are already diversified. I like to invest in these types of companies because there's less risk and there's more consistent gains over the years. The second principle I follow is I really just invest. I don't like to think too hard, because if you follow the first principle and it's already diversified into a lot of companies, and let's say you want a more tech savvy diversification, or you just want a more standard diversification into the S&P 500, you're good. Follow that first principle, now I just invest, right? It's run by real people, they're following real companies, and they're following the top companies. So I just invest because I know over a long course and period of time, right? I always use this example, the S&P 500, it gets consistent returns over a long period of time. Maybe this year it only gets 5%, maybe the next year it only gets 4%. Over 10, 20, 30, 40 years, it will see an average return of around 8 to 10%, not including inflation. And this is what you have to know. And the third principle is to really just invest based on your timeline, right? So there's various risk factors included depending on how stable you want your investments to be or how more risk you want. So the older you are, the less risk you want to take, right? So you want to invest in more secure things such as bonds. But the younger you are, the more risk you're allowed to take because you have more time to build that compound interest and allow your money to grow. So right now, me personally, I only have 5% of my investment portfolio in bonds because I want to maximize my growth as early as possible. That's a risk I'm willing to take, but someone who's 35, they may not be willing to take that much. So they may follow a different rule and say they put 20% into bonds. I use bonds because bonds are a much more safer investment because they're backed by the government. So understand your age and your risk tolerance and invest based on your timeline. And now I'll give you the 2 stocks that I've been investing in the past 2 years that is going to put me on track to become a millionaire in 30 years. So the first one is FXAIX. What is this? It's the Fidelity 500 Index Fund. So it's Fidelity's version of tracking the S&P 500 essentially. It tracks the overall US market, top 500 companies, very low fee, right? And very expected results on a yearly basis. So we know what we're getting out of it, and it's very low cost. And so FXAIX, it's pretty much just a fund, it's a mutual fund, and it's a very steady performer. The second stock that I've been investing heavily in is VOO. And it's essentially the same thing as FXAIX, but different. Because while yes, it does track and follow the S&P 500 and the US stock market to a T, it's different because it's an ETF. It has a little more fees than FXAIX, right? But here's the thing, it's a lot more tax advantaged than FXAIX. And this is due to VOO being an ETF and not a fund. So that's why I'm investing in VOO and FXAIX. And this last point, I'll really just share with you some goals that I'm working towards while I'm still investing and while I'm still living my life and traveling when I can, right? So another goal that I'm investing for is to eventually buy my own house. And I'm doing this through my individual brokerage account, not my 401k, not my Roth IRA or my high yield savings account or my HSA investment account, right? So I have a good amount of money saved up, and you should be able to invest for different things, for different purposes, while securing your long-term goal to retire early. And it's definitely possible, and I'm doing that right now. And eventually down the line, not now, not in the next 5 years, unless something happens to it, I want to get a new car. There's nothing wrong with the car I currently drive. It's a Lexus GS 350. It's perfectly fine. I've been using it for a good amount of time, and I know down the road that I want a new car, but not now. And I'm not going to kill my future gains just to get a new car or satisfy my instant gratification for right now. But if I'm in a very healthy position and I have the ability to do so, I'll think about getting a new car, right? And so if you found this video helpful, please leave a like, subscribe to my channel, and comment down below what you think about the advice that I gave.